And hello, Nick Bendel. Welcome back again.
Great to be here.
And Nick, you're here for the weekly news on the For the Property Investor podcast. And you bring the news and I talk about it.
It's a great combination.
So thanks again. And let's get into it. What's happening in the news this week?
Well, let's start with some good news. Good news on the inflation front. Inflation has continued falling, bringing us one step closer to the day the Reserve Bank begins cutting interest rates. The Australian Bureau of Statistics has two inflationary measures. On the monthly measure, inflation fell from an annualized rate of 4.3% in November to 3.4% in December. And on the quarterly measure, which is regarded as more accurate, inflation fell from 5.4% in the September quarter to 4.1% in the December quarter. That means inflation is now within touching distance of the Reserve Bank's target range of 2 to 3%. Commonwealth Bank has said inflation is likely to keep falling and that the Reserve Bank is going to reduce the cash rate by a total of 1.5 percentage points by June 2025. Owen, does it feel to you like we've broken the back of inflation?
Yes, definitely. It was a huge drop for the December quarter and big relief for everyone because it's almost like this weight is lifted off the economy and off mortgage holders, especially for where interest rates are going next. And yeah, I don't think there's any reason why the Reserve Bank would need to raise interest rates again from here on in the foreseeable future. It's what we've all been waiting for, and it's like a big hooray, relief. And it's in terms of where it's going next and by when. I think there could be a good reason to cut rates by the middle of the year, because what we don't want is for inflation to keep going down all the way. We need that soft landing. And there's been a lot of people, including myself, who think that the RBA raised rates too much and too quickly and didn't give enough time for those rates to really kick in and have that effect. But I think they dropped rates too much too quickly as well when they were dropping rates. So it's let's wait and see. And here's hopefully to having a rate cut before the end of the financial year.
Well, you've made the connection between interest rates and inflation. So when inflation really went up a couple of years ago, the Reserve Bank really aggressively increased interest rates, as you said. And the reason they wanted to push up interest rates was to reduce demand from the economy and thereby drive down inflation. And you've raised the idea that maybe they've removed too much demand from the economy and therefore the economy has slowed too much. And perhaps we'll see that if inflation really, really falls below the target range of 2 to 3%. And then that's why potentially some economists think at some point this year, the Reserve Bank will start cutting the cash rate. And you kind of raised the idea that maybe that might happen as early as the middle of this year.
Yeah, because we don't want this seesaw effect to start happening where you're rapidly dropping rates and then rapidly rising rates just to get the inflation down. It's also like that'll just take confidence out of the market altogether. And we need stability in the market so that the market can make sane, rational decisions rather than irrational, emotional ones driven purely by opportunity and the desire to be able to take advantage of these circumstances where you've got really low rates and to purposely drive things artificially, and which is why we saw what happened during 2021 and 2022, and with property prices going crazy all over the place. But it really was, an artificial measure of the RBA, because it was really dropped too much at the time. It was pretty obvious. I don't know. I'm not on the RBA board, so I don't have any influence.
Well, not yet.
Who knows? Maybe one day.
And okay, so let's assume that the Reserve Bank does start reducing the cash rate at some point this year. What would that mean for the property market?
It'll provide some stability. It'll take a lot of the, because at the moment, it's a bit like needing your brake pads replaced on your car. You've got that grind, you've got that noise every time, each month turns over, and you've got that repayment happening, and you just want to put the brakes on, but you can't, and because it's just really uncomfortable. So
do you think it'll lead to more buyer activity and maybe more seller activity as well?
Possibly. It can lead to both, because there's the activity of one will lead to the other. So if people are feeling more confident about buying, then property owners will feel more confident about putting their properties on the market to try and take advantage of that. And then the snowball effect happens. So we need a more stable market as a result.
Okay, well, that leads us on nicely to our next story. More people are taking out home loans. Mortgage volumes trended upwards throughout 2023, reflecting rising buyer activity and also rising property prices. Owner-occupiers took out $16.8 billion of home loans in December, which was 7.4% higher than the year before, according to the Australian Bureau of Statistics. And investors took out $9.5 billion of home loans, which was 20.4% higher than the year before. So up 7.4% for owner-occupiers and 20.4% for investors. So while borrowing is rising across the board, investors are leading the charge. Owen, I know that your company, Leafield, is very active in the rental market in multiple states. Have you observed this increase in investor activity over the past year?
Yes, definitely, but it's very targeted. So it's very targeted at specific types of property, and it's more so high yielding, high income properties.
And that's because interest rates are higher and people are more concerned about cash flow?
Yes, exactly. They're looking more at being able to get those returns so they can hold these properties for as long as possible, no matter what interest rates do. And the outlook, even though capital growth still comes into the mix of why they're buying, they're more so looking at that as a long-term hold strategy and taking advantage of capital growth no matter when it happens. But in the first instance, let's buy a property that we can hold long term no matter what, due to the income being good.
I always find it interesting, these on the ground observations you have, because you're there every day in multiple states, your company. I kind of, on the same line, moving on to vacancy rates. What's interesting is vacancy rates have been incredibly low over the past year, even longer. But if we focus just on the past year, they've been incredibly low, but they've been basically unchanged over the past year. But even though vacancy rates have essentially remained unchanged, the data suggests that the average number of people looking at each online rental listing has declined. and that would seem to suggest a decline in the number of renters viewing each property. Has that
Yes,
been your experience?
absolutely. It's yes, there is still a rental crisis out there, but it's a lot more targeted now and to specific suburbs. It's not necessarily across the board. And it's so yes, even though the average might not have changed, because there are still areas that have very, very high demand, there are some areas where it's taking longer to get properties leased. And the property owners coming to us and saying, what's happening? What's happening? And that's where we have to do price adjustments. So in some areas, we've got lines out the door of people wanting to get in and multiple applications. And then others, it's we're getting crickets. So it's not the same everywhere. It's not like it was 18 months ago, where you put a property on the market and you get multiple applications in the first 2 days. It is different. The market is changing, so there's not as many people looking. There's not as many people staying, and the rent values are leveling off. Now, again, that's in a lot of areas, but some areas are really booming.
Okay, we'll hold that thought. For our final story today, it's also on the rental market. Unit rents are growing faster than house rents. First, so let me go into some of the detail. January was the 42nd consecutive month of growth for Australia's median rent, according to CoreLogic. In most capital cities, unit rents have grown faster than house rents over the past year. For example, in Perth, over the past year, the median rent grew 16.5% for units, 13% for houses. In Brisbane, 12.6% for units, 6.8% for houses. In Sydney, 10.9% for units, 8.9% for houses. In Adelaide, 9.8% for units, 7.9% for houses. And in Canberra, 0.5% for units and minus 1.9% for houses. However, there are 3 cities where house rents have grown faster than unit rents over the past year, and they are Melbourne, where the median rent went up 11.1% for houses, 10.2% for units. Darwin, 3.4% for houses and 2.7% for units. And Hobart, minus 2.3% for houses, but minus 3.2% for units. So, Owen, this touches on to what you were saying a moment ago. Rents have gone up for now 42 months in a row, which is astonishing. But can rents keep rising forever? And if not, what would bring this rental growth to an end?
No, they can't keep rising forever. And we can always come back to our what we keep talking about, which is supply and demand. But that's not the only factor. It's but yeah, with those Perth figures, that comes back to what we were just talking about in terms of demand outstripping or more obvious in certain areas of the country, like Perth. And I guess Perth is just on a different cycle, and so they're a couple of years behind economically, no other way. And then the eastern cities. And when we look at units, why are they growing faster? It's there was a huge disparity between the growth during COVID of houses. So rents actually went back a good 30% in Sydney units in 2021. And when you look at houses at that time, they grew a lot more than units did. So it's that disparity now with units is just showing the we're showing the difference between where a lot of people are going back to units now in the last year or two versus houses. And, except for places like Melbourne, where I think the shift back happened a lot quicker. And there are a lot more inner city units in Melbourne as well.
So this shift back to units that you're talking about, Owen, is that due to affordability? Is it due to cash flow?
It's I think number one, it was moving back to the city, because there was that huge exodus for those first couple of years during COVID out of the city, and everyone wanting more space and more room to work from home, etc. And so now that there aren't those restrictions, a lot of people wanting to get back to the office. We've had a lot of international migration come back. So a lot of internationals are used to living in units. So that's where they prefer to live, and they want to be close to the city or close to universities, or close to where they're working. So it's and affordability comes into that as well, because they are obviously cheaper to rent. So that then comes into it as well.
Do these things, in your experience, do these things move in cycles? So sometimes units grow faster than houses, sometimes house rents grow faster than unit rents?
It's in general, pre-COVID, that the growth would be fairly similar. On average, if you looked at across whole markets. But if you looked at individual smaller markets, then that's where there would be disparities between the two. So especially in smaller markets where you've got a lot of influx of new units, and very sort of large high density developments happening at that time, you'll see the unit prices dropping quite dramatically, because everyone wants to get them filled very quickly. And you can see that in different pockets, especially around Sydney, where there's a lot of these larger high density developments happening at times. And yes, you can see those rental returns dropping quite dramatically, and they can tend to last for a number of years, while there's a lot of development going on. So yeah.
So we've talked inflation, interest rates, home loans, rents, vacancy rates, and we've thrown in a little bit of supply and demand as well.
Yes, we have to get it in there at some point. Yeah.
Excellent. Well, thanks for the chat, Owen.
No worries. And Nick, Hunter and Scribe is your business. Tell us a bit more about it.
Hunter and Scribe is a copywriting agency, and we write content for property and finance professionals, people like buyers agents, real estate agents, mortgage brokers, accountants, financial advisors, lenders, and credit repair agencies.
Great. And the best place for people to get in contact with you is LinkedIn.
Definitely LinkedIn. I'm very active on LinkedIn. So look for Nick Bendel, Bendel on LinkedIn.
Great. Thank you. And you're listening to us here on For the Property Investor, which is part of Leafield, which is a national property management business. And so we look after property investors across 4 states. And we work very closely with buyers agents, sales agents, as well as finance professionals as well. So thank you for being on here again, Nick. We'll see you back next Monday with the weekly news, and who knows what's going to happen this week.
Thanks, Owen.
All right. See you, Nick.